Now, short selling is shrouded in mystery and is believed to be reserved for these really high-level investors who really knows what they're talking about. But what is actually short selling, and does it even make sense? Welcome back to another video. I'm going for a bit of a basic one today, but maybe not so basic. Talking about short selling, or borrowing as it is called. Please give the video a thumbs up if you like it. Subscribe for more content. I post a video every Monday at 8 p.m. EDT or 2 p.m. CEST. Stay tuned for that. Timestamps in the video description. Let's get going. So short selling or borrowing shares is the process in which an investor borrows shares in hope that the price will go down and benefit from it doing so. Let me give you an example. So let's say you borrow 10 shares of Banana Inc. from your broker at $100 per share. You then turn around and sell those shares on the open market, leaving you with $1,000. But you now owe 10 shares of Banana Inc. to your broker. Now, next thing that happens is that the price of shares of Banana Inc. falls 20%. And you see the chance to buy the 10 shares back off the open market, but now for $800. You can now repay your debt of 10 banana shares, leaving you with a total profit of $200. Now, that's the basic of short selling, and it's usually explained as some sort of financial jujitsu that is only reserved for the most advanced investors and is portrayed as this big risk, big reward, big balls sort of play. Logically speaking, however, it's more like big risk and small reward. You see, the problem with short selling is that you can only make 100% return, so the share price going to zero, while a short seller can lose an infinite amount of money, because stocks can, in theory, go up tens and thousands of percent, leaving short sellers in the dust. Take someone shorting Tesla back at $45 post-split valuation. The short sellers stood to gain exactly 100% if Tesla went bankrupt. Instead, though, they lost 900% in the coming 12 months. Now, this is all in hindsight, but I don't think the risk-reward analysis of that trade would stand up to much scrutiny. On top of this, as a short seller, you're betting against the trend that stocks go up. In fact, stocks go up about 2/3 of the time. So any given year, stocks will most likely go up. And on good years, stocks actually go up more than they go down on bad years, crushing the myth of stocks tumbling faster than they rise. I mean, sure, a blood red day on Wall Street will be way worse than a good day is good, but most investors, even short sellers, aren't day traders. They're betting on long-term downwards momentum, which happens very rarely. So you're just betting against the trend. The second thing you're betting against is another trend, the fact that stocks tend to bounce back when they go down. So whenever a stock price falls dramatically, investors usually jump in and buys more of the stock because the prices are cheaper. And so as a short seller, you're betting against the trend that stocks go up, and even if they go down, you have to time your trade really well and get out before investors jump in. So you also have to time your trade better. So short selling is actually quite hopeless. The third problem with short selling is that it costs you money. Say what? Well, if you borrow shares from your broker, you actually have to pay an interest for that loan. The costs can vary, but short selling actually costs you money from day one. The second cost is that you have to cover any dividend that the stock pays. So if a stock pays 2% dividend and you short the stock for 1 year, you have to pay 2% of your entire position to your broker to cover the dividend. So not only is the likelihood smaller, it also costs you money. And if short selling doesn't seem risky enough already, on top of the natural bounce back effect that makes it really difficult to actually stay short a company, you have what we call a short squeeze, which is when a heavily shorted name, like Tesla for example, goes up, the shorts gets squeezed, meaning they have to cover their positions because the prices are running away. So if someone shorted Tesla at $45 post-split valuation, most of them will start covering once the stock goes up 100, 200, 300%. And they have to reopen their position. So when prices starts rising, short sellers are forced to buy the shares of the company, actually sending the stock price even higher, which is what we called a short squeeze. One of the biggest examples of this was back in 2009, when investors or short sellers speculated that Porsche acquiring a majority stake in Volkswagen would cause the stock to tumble. Once they found out, however, that Porsche had already acquired 70% of Volkswagen, they all panicked and everyone tried to cover immediately when the new news was announced, ending in a short squeeze of epic proportions, sending the value of Volkswagen so high that at one point it was the world's most valuable public company. So this is one of the risks you run as a short seller. And I usually say that lazy investors do well, because simply buying shares and holding forever and never looking at them again is usually the best strategy, and statistics and logic backs this up. So instead of using a lot of time to do research and due diligence to try and find these few bad apples in the stock market, just go with the trend. I mean, even if you pick some bad stocks, like some big unloved company like Coca-Cola, GM or Disney, you're still not making any money because these companies have stagnated compared to the rest of the market, but they haven't gone down. So you haven't made any money even if you find these bad underperforming stocks, because underperforming stocks sometimes just stays flat, which is bad enough, but you're not making any money. And the whole time people have been shorting these kinds of stocks because they think they're going to go down, they could have been collecting the dividend from these stocks instead of paying the dividend plus the interest to your broker. So not only do you have to find bad apples, you have to find some really rotten apples to actually make money short selling. And even if you think the stock market is way ahead of itself and you think it's bound for a correction, I would carefully digest the words of John Maynard, who said that the stock market can stay irrelevant for longer than you can stay solvent. So even if you think something is going to happen, you never know how long it's going to take. But once every decade or so, some big well-known billionaire investor short seller comes along with a big home run, like Jim Chanos with Luckin Coffee, Michael Burry during the financial crisis, or Fahim Kadir with Valiant Pharmaceuticals. But they could have spent all the time researching these companies to find some growth companies where they can make way more money. Like if you were invested in some of the big growth stories over the last 10 years, like Apple, Tesla, Nvidia, Netflix, Amazon, Salesforce, or Domino's Pizza, you could have made anywhere from 3,000 to 11,000%. So picking growth stories is a lot more lucrative and you have a higher chance of actually being right. So to sum up my thoughts on short selling, you're trying to search for bad apples while you should just go with the trend. Your potential reward short selling is lower. The chance of being right is lower. It costs you money. It requires more due diligence and research, and the potential return going long growth companies is way, way bigger. Short selling is a waste of time and money. So that's my thoughts on short selling. This is just my personal opinion, not investing advice. I guess it's my personal advice, but don't take it to heart just because I'm saying it. I would recommend no one ever do short selling. As I said, I think it's a waste of time and money. So that's my video on short selling. Let me know what you want to see a video about, but my next video will be on the Osborne effect. What is it and what does it mean to an investor? Stay tuned for that one, and I guess I'll see you then.